I welcome you to this Elliott Wave Analysis webinar. My name is Rüdiger Born, and the next 60 minutes are dedicated to the Elliott Waves, and we want to see how the Elliott Waves work, how the system behind this, what the rules are, what the guidelines are, and of course we want to see the practical use. We want to see the charts, we want to see the ugly real life situation, and want to see how we can apply this technique to the normal chart. And I want to do it quite easy for you because I know that the Elliott waves are not really simple to understand. It's not for the first glance. You need to have experience to work with it, but I learned by myself that it is way more easier if you start with an easy way of doing it and then step by step bring more knowledge into this. This may help you to get deeper and deeper and get more sophisticated with the Elliott Wave. So I'm really happy you are here. Before we start with a little bit of theoretical things, just one slide to my person. I'm a trader since early in the 90s. I started 1993 with intraday trading. Before that, I really had to walk to the bank or call them and really ask them, please close my position today. But from 1993, I had internet in my house, so I could use intraday trading, and I really liked it from that point on. So I really traded from that point every day, nearly every day, I have to confess, and many hours. So with the Elliott Waves, I really love the Elliott Waves. I started at the end of the last century, so it is, let's say, 15, 16, 70 years ago that I applied Elliott Wave for my trading, and this changed my way of trading and the results very much. So I could really recommend thinking about this. It should be a really good experience to work with this. However, you can see I'm trading a lot of different things. The indices, of course, the futures of the indices, and the stocks, the currencies, also commodity, bonds, whatever you like. And you can apply Elliott Waves to all of this. So you're not obliged to work only with one market. You can try whatever you like to trade, and you can stay in your favorite time frame. You can use this in a really low time frame, let's say in a 5-minute chart, or even below if you have the perfect market for this. Of course, you should not do in a 1-minute market in a really small stock. But if you go with the futures, for example, or with big currencies, you can, of course, go to low time frames also. But if you don't like to trade on a low time frame, you can change to weekly or even monthly charts and have the same good idea behind the trading. So you can use whatever you like, and you can mix it up, of course, and go between the time frames, whatever you like. Before we start, one legal things, especially here in Germany, I have to tell you that I'm a trader. I have a asset management company, and of course I'm trading nearly every day, so also today. So maybe when we later go to the charts and I have an idea about the trading, I may have a little bias. If I have a position in this market, maybe I'm biased. So please think about whatever I'm talking to you, whatever I'm telling you or seeing. Maybe try what you see in this situation and whether this helps you or not, whether this is fitting to your trading style or not, and of course to your account size. So don't just copy, just try to understand what I'm doing, and if you think, okay, this is really a good one, then maybe you can apply for yourself. So that is from the legal point. Just let's go a little bit deeper into the Elliott Wave in a theoretical way. So the first half, it's not necessarily the half, but the first part will be a little bit with the slides here, so that I can give you a little bit an impression about the Elliott Waves. But after a while, we will switch to the charts, and I think this is more or better working to work with the charts than only with the theoretical slides. So first of all, let's have a look what it is. You don't have to read all of this. It's not so much important for your trading, but just a little bit of background information to know when it started and how it works. what I really like and what really is important is to know that this is patterns of behavior. This is really, really important. If you understand this, that the market is moving in pattern, and you can understand how the patterns are, then it helps you a lot to understand how the market will be in the very future. So you can understand and you can apply whatever you see there. So this is a really big point. However, it is not that if you can count something, that is definitely working out like this. It can change, it can be different. It's not the exactly way which the market will go. It is only an idea to, let's say, to feel what the market is doing currently. And if you have a group of countings, you will realize, maybe they're a little bit different. They are not all exactly the same, but more or less they will bring you to the same levels, at least in a certain part. You will understand this later when we see the chart. So please don't be afraid if you see, I can count this special part of the chart in 1, 2, or 3 different ways. This could not be correct. Maybe it is correct, maybe it is sticking with the rules of the Elliott waves. However, even if you're not sure which one is the best one, you will see later and you will understand later it does not make a big difference. Maybe you have a tight target which is not so far away, or maybe you have a far away target. We will see that later. However, you can estimate where the market is going, at least at the first glance, and you have a good idea what the market is doing, and then you can decide, okay, I will open a position and maybe let it run, taking profits or trailing stops, depends on your own trading idea, whether you like to take profits or if you want to have the big deal. So then you can decide, I'll switch back to a trailing stop idea. So you can do this later, but the first is that you're not absolutely wrong. If you have a good counting set, then you have a good chance that you're not completely wrong all the time. So that's maybe the best explanation you can have on this one. If you're talking about the Elliott waves, you have to decide between 2 possible moves. First one is impulsive. This is a really, really nice one and a really, really important one. If you understand what an impulsive move is, you have done half of your work. But it is really easy, at least in the easiest way to apply this, it's really easy to understand what an impulsive move is. However, if you want to dig deeper into this, then you can decide or divide the market into 3 different patterns which are all impulsive moves. The best one, the most important one, is an impulse. But there are other ones which I don't want to talk about too much about this today, the leading diagonal or the ending diagonal, because these are special forms which I don't want to talk about today because it takes a long time. However, if you understand the first one, the impulse, if you understand how it works, then later we can talk about the ending diagonal, for example, which gives you good trading ideas too, but it's not so much important because from probability it's best to search and to see and to understand how an impulse move works. So first, at the first glance you can see all of them have 5 moves, and this is wonderful because this is exactly what it is. It is a 5 waves move. 3 waves are going up, divided by 2 corrective patterns in between, which brings the market down a little bit. Exactly the same on the downside. So if you have a short market, it's exactly the same, but in the other direction. But the system behind this is absolutely the same. So don't worry about long or short situation. It is working for both directions. So what are the most important things you have to know about impulses? Very, very important. It is absolutely necessary to understand these are 5 rules for impulses. Everything else we can talk about later, but these 5 rules, if you understand these ones, it's really, really good. You know, you cannot be wrong in the future. seeing something like this. So let me draw something beside this here on the slide so that you can easily understand what it is. So it's a 5-wave move. Just to train your eyes on this, this is a 5-wave move. Just have the first one up, a second one down, a third one up, a fourth down, and a 5th wave to the upside. This is quite easy. After 5, you know, okay, this should be done. Everything what is coming higher, it is maybe a subdivided or a fractal of one of these waves. However, currently we're just talking about 5-wave moves. Very, very important. It's a must-have. The second wave is not allowed to fall below this starting point. This is a starting point. Just to give you an impression of what the market did before that, because this is a 5-wave move to the upside. Obviously, it's a bull market. So before that, the market must have come down. So we don't know so much about the history. This is not important so much currently, but the starting point is this one. Here, the ball at the beginning, and after this, we have the first move up and the second down, and this end of the second wave, this end must be minimum at the same level, but should be higher, and normally it is higher than the start of the first wave. This is absolute crucial. This is a no-go. If it's not like this, then you definitely know, okay, it's not an impulse. So that's really, really important to understand. Sometimes the market is going below this point, but it is no way that it is an impulse like this, what you see. So don't think, oh, the market cannot come down below this point. Ah, that's a good one, so I can go long, nothing can happen, and I don't need any stop. Yes, you need. But if it is going down, then you know definitely, okay, it's not an impulse, whatever it is, but it's never ever an impulse. That's really, really important. Second one is the third wave is never the shortest. This is the third wave, and it's not the shortest. This does not necessarily mean that this is the longest, but definitely it's not the shortest wave. Sometimes the 5th wave is even longer than the 3rd wave, but it's never ever the shortest. If it's shorter than all of the other ones, then you know, I understand this is not an impulse. The 4th wave is not overlapping with wave 2. This is also absolutely crucial, but it's easy. And the good thing is it will be easy for you to read, because overlapping is a thing you can see at the first glance. So if you see something like this, it is 5 wave, yes. The second wave is not going below the start of the first one, yes. The third one maybe is not the shortest. I'm not absolutely sure. I could do better next time, but you can easily understand, okay, maybe it's not the shortest in this case. However, the 4th wave is overlapping with the second wave. Remember, I do it a little bit thicker, a double line. The corrective pattern, the first corrective one, the second here, this one, and the 4th one, they are overlapping. So this low is lower than this top. So you can easily understand, okay, this is definitely not an impulse. We will see what it is later, but definitely it's not an impulse. If you see this, you know, I understand you're not knowing what the market is doing. It's absolutely not impulsive in this situation, at least not an impulse. Okay, really, really crucial. And the last one, this is for the let's say for these people knowing a little bit about this, the internal structure is impulsive, corrective, impulse, corrective, impulsive. Maybe this is too much for the first contact of the Elliott waves. So if you're starting now with the Elliott waves, don't worry so much on this one. We will come back to this in a later webinar, I guess, because this is a little bit more, you should dig deeper to understand this maybe. So the internal structure could be something like this. I don't want to bother you with this one. Just if you are a little bit an expert already or heard about this, you will find, I understand this a little bit. If you don't know this, then don't worry so much, because we will come back on this later in one of the later our later webinars, and digging deeper here. For the first glance, it's not so much important, because I want to give you an easy start into the Elliott Wave. So what we have here is a simplification. The first one is clearly a 5-wave pattern. You can clearly understand which waves are going strongly into the direction of the trend. 1, 3, and 5, and you can easily understand which is going again against the trend, and also this one is going against the trend. So you can easily divide the whole move into these 5 parts, so it's not a big problem to do so. The other one is a simplification, that sometimes you cannot divide this. You cannot understand where's the corrective part. I don't see it. But I think if you see a market like this, there's no way to get the market wrong. This must be impulsive, massively impulsive. Later I will show you what the other parts of the wave is. It will be a corrective one. But this is no way that this one is a corrective pattern. There's no chance to do. You will easily understand if you talk about the corrective patterns later. So keep this one. If you see this one, you say, hey, that's wonderful. We cannot be wrong. I have some others, just fly over this one. It's not so much important now. It is just to give you an idea what the market is doing normally in case of an impulsive move, especially if it's an impulse. You know, impulses are a special form of impulsive moves. It sounds nearly the same, but there's a difference between impulses and impulsive moves. You remember we had leading and ending diagonals, which are all impulsive moves, but only impulses are what we are talking about now. Okay, very important and a good idea to understand what an impulse is it's a 5-wave without overlapping, or you can draw it with a ruler. If it's something like this, one step, you cannot do in a different way. It does not matter whether the market is going like this. It's just one draw. It's nothing to do. So you need to draw so much with this one. It's just one strike to go there. So this is easy, an easy form, a simplified form of an impulsive move. We will see this later in the real chart, so it will be easy for you to understand. Okay, what's the other time? The other part. If it's not an impulsive move, it's a corrective move. So we have to talk about this one too. And there are several different shapes. You can divide 3 different shapes mainly: a sharp correction, a sideways correction, and triangles. Today we are not talking about triangles. Triangles are a really cool form if you see them. Unfortunately, statistically, they are only in, let's say, 10% of all corrective patterns, or even a little bit less. I'm not absolutely sure about the number, but however, they are not so much important to know for the first step. But later you will see this is a really helpful pattern too. If you see one, it's not so much often, but if you see one and if you can clearly understand, oh, it has to be a triangle, then you will be really happy because you know what will happen next and over next. So this is a really cool one, but not for today, so we leave it out in the moment. However, there are 2 corrective patterns, which or group of corrective patterns which are really important: the sharp one and the sideways one. No matter which one, you can see they normally have a 3-wave pattern. It is not like a 1, 2, 3, 4, 5 wave. It is only like a 3-wave, and as it's a corrective one, we name it with letters. So it's an A, B, C. It also can be in the other direction. It looks like A, B, C, for example. So also for the bulls, sometimes this market is going to the upside, so you have an ABC situation here. It does not matter whether this is a sharp or a sideways correction. In both cases, just name it with these letters. Sometimes we use different letters. Maybe you've seen this with WXY, for example, and some more sophisticated forms to separate all the waves counts here. But for the moment, it's the easiest way to keep it with an ABC notation, so we don't want to dig too deep here in the moment. The very, very important one is a zigzag. It's one of the most important corrective patterns. We have two very important, and the zigzag is one of these. For the bull market, it looks like this. A, B, C is going strongly into one direction. However, it's going only in a three-wave pattern, so only three waves named with letters. However, also similar to the impulsive moves, the B wave, so the second wave, does not go below the start of the A. So there's no way that this is going below this one. Or vice versa, of course, if this is the start for a bearish one, this one is never ever going above. If it's going above, it can go above, of course, but then it is definitely 100% sure not a zigzag. It's not allowed. If it's going above, then it's definitely not a zigzag. You can be sure if it's a zigzag, it's normally way away from this level here, so there's some kind of a big distance. It's not nearby, it's not overshooting, it's not nearby. If it's a zigzag, there's a gap between the start and the level of the B wave, of the end of the B wave. The internal structure, also again for our more sophisticated or Elliott Wave lovers so far, the first one is an impulsive move, the second is a corrective move, and the last one is an impulsive move, which could be divided in a leading and an impulsive at the beginning, of course leading as a beginning, and an impulsive, or an impulse or an ending diagonal at the end. Of course, the name is programmed, so it's easy to understand that this one is at the end of a zigzag. However, these are the rules for a zigzag. Of course, there are some guidelines too, but I don't want to talk about this today. So we may have a special on this in the future. So if you like to talk about this, and if you have more questions about this, then we have a good chance to do this in a later webinar to bring more information on this one. Sharp correction could be divided in several sub-forms. However, zigzags are the most important. Everything else, I call it ugly. If it's looking ugly, if you clearly can see, oh, there's overlapping, the market is not doing nicely, I cannot count it, I'm not sure how it is, I cannot draw it with the ruler. You cannot draw this with the ruler, only if you bite inside a little bit. But this is like using a comp or something. Definitely, it's not an impulsive move. It should be something corrective. If it's ugly, it should be corrective. But I don't care so much whether this is this form, this one, or there are some others. If it's a nice and clear, brilliant one, that's a good one. Or it's ugly, also this is a corrective pattern. The sideways correction, most of the times are flat. This is the other part. Both of its zigzag and flat are nearly the same. Has the same probability of occurrence. So in both cases you can think, okay, if it's a corrective pattern, it's half of this is a zigzag, half of it is a flat. That's not absolutely correct, because sometimes there are other forms, but also this have really low appearance, so it's not so much often that this happens. Sometimes you cannot understand the real difference between both of this, because they are looking same, yes, but they have a little bit different internal structure. I don't mention this anymore today. So it is interchangeable. You can interchange flat and double sideways because they're nearly looking the same. However, the rough pattern is exactly the same. So whatever you see in this will lead you to the same conclusion. Okay, for flats, also same rule, nearly same rule, also 3 waves. And if you have this as a starting point, the A wave down, let's say with big letters, no, does not care. I'm not caring about the letter, big letter, capital letter, or small letters. However, the A wave here, the B wave is near or sometimes even above. Oh, this is a glitch. This should not be. So I try to undo this one. So the B wave should be near or even above this level. This is absolutely possible, and that's the reason why we call it a flat, but because of course it's going deeper later, or lower later, not deeper but lower. We are coming back. So it is it's a down move, definitely, but you can easily understand that this move really much is using the same price level all the time. So it is looking like a flat, like a sideways correction, much more. So that's the reason for the name. However, the B wave is overshooting, or at least near this level, the starting level of the A. So this is the history before that. The pattern starts at that point with an A to the down, a B to the upside, and a C to the downside. Okay, if we understand this one, then we have most of it done already. The triangles I will not mention, but however, if you see something like this, I think there's no way you can interchange this with impulsive move. There's no chance to do so. If you see this, it's definitely corrective. You will never ever feel wrong in this case. Some guys saying this is a flag or some kind of a triangle situation. Yes, it is. And if you're an Elliott Wave analyst, you would say, okay, it's not only a triangle, it's in this case a contracting triangle with certain rules which we are not talking about today. However, I like to have it simplified, especially if you want to, when we go to the charts in a few minutes. So we just need to divide the markets into impulsive moves and corrective moves. And the simplified way for the corrective moves are, it is a 3-wave pattern. Could be sometimes like this. However, it's also a 3-wave pattern. Not more, not less, just exactly 3. Or it's more or less. No, less is not possible. It has to be 3 minimum. But however, if it's more, it most of the time looks however ugly. You don't know what it is. You may have seen that the market is going like this. Maybe you have a good idea in the current moment of the market. Maybe we can see this in the indices in American markets, for example. However, this is something which is definitely not interchangeable with the impulsive move. However, it must be a corrective pattern. So it's easy to understand this, and it's easy to apply this, you will see. So I think we have done most of it already. So just the last few things we should talk about before going to the chart. This is internal structure. Again, you can see the whole cycle, which is an impulsive move at the beginning, an ABC corrective pattern, and then we have a strong move to the upside and an ABC pattern here, and so on. And you can see there's a fractal thing. You can easily see that the third wave by itself is a 5-wave impulsive move, and if you have a magnifier glass here, you could see that even the first wave may be looking like this. Not for sure, sometimes it's really like a straight move to the upside, but if you see it in a little bit lower time scale, sometimes you can see, we have a 5-wave structure here too, and the same with the 5-wave, the 5th wave here, it also should be something like this. But we want to come to the practical things. So the first thing is how to apply this, and how deep should I dig into the Elliott waves. I'm quite sure if you understand the first start with this, and if you start trading or at least analyzing with this tool, you will start to love it, and you want to dig deeper, you want to learn more about this. However, the first thing is we always want to trade the sharp moves. We want to see the market is moving. And the good thing is, the dynamic move, the impulsive moves, are normally going into the direction of trend. And corrections are counter trends. If you can understand this, this is really the most important thing. So if you see something like this, this is clearly indicating a trend. It is in this case not overlapping, it's a one stroke or one strike move. Okay, this is the direction of the trend in this case. The counter trend, the corrective pattern, is going in the other direction. So I think it is easy to understand which one is a strong one, which one is a weak one, which one is the corrective pattern. Yes, of course. This is the first grade question. This part is definitely the corrective one. It's going counter trend. This is something we don't want to trade normally. This one is the strong move, is a good one. That's the one we want to see. And typically, most of the time, after this strong move to the upside and the counter trend to this side, when the counter trend ends, what will occur? The continuation of, I don't know where the glitches are today, but however, you know what I mean. I can just redo it for you. If you want to see the recording at the end, it's easier maybe to understand this if you want to work through it again and again. So this move here, this is the continuation, the next part of the trend after the break. So if you understand this, then you have done most of the work, because it's really, really easy to see in the market where it is. So the dynamic moves, the impulsive moves, and normally the Elliott Wave fans should say the impulsive moves should be traded. However, at the beginning I can understand, I know it from many coachings I did, from many seminars and contacts with traders, starting with the Elliott Wave stuff, I understand that this is sometimes a little bit tough to understand. However, you will nearly never mistake a dynamic move from a counter trend move. So dynamic moves should be traded. They are funny. If you have a move like this or a move like this, you will have a lot of fun, because wherever you enter the market, in this case to the long side, into the direction of the trend, whether it's here, 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 or here, even here, 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 you will always have fun, no matter where you enter the market. Corrective patterns look like this. Here is the big difference. You may have fun here. You will be happy if the market is leaving your entry area. However, after a while you will feel really bad, because the market is coming back to your entry level, and sometimes even overshooting, and so you will be really unhappy, sometimes even stopped out. So even if at the end the market is really high and give you a good idea, okay, we are high enough for a profit, most of the time, even if you enter the market at the very best point, you will not feel well. And you can imagine what will happen if you enter the market here or wherever else. You will not feel better, it is even worse. So try to trade the dynamic moves and try to avoid the corrective moves. This sounds to be simple. Indeed, we should not listen to a webinar like this. They are telling us the obvious the obvious things. Yes, indeed. But it is, if you understand the Elliott Wave, it is easy. It's really, really easy to understand what to trade and where to stay out of the market. And if you remember your own trading success maybe so far, you can easily remember where the profits came and where not. So if you can understand what is coming next, then you have a good chance to make profits. So I have here the comparison of two typical Elliott waves. Maybe you can name it already. The left one is an impulsive move. To be exact, it's an impulse. It's a 5-wave pattern, no overlapping. All the rules are okay here in this case. On the left, on the right side, you see it's a zigzag. It's a 3-wave pattern. All the rules also are here. Okay, no conflict. However, until this point, everything is exactly the same. So you cannot understand which it is until that point. Only after leaving beyond or going beyond this point, you can understand, most probably it will be an impulse move and not a zigzag. Yes, that's correct. So the good thing is you don't need to know in advance whether this will be an impulse or a zigzag. In both cases, you can earn money. Maybe in this case, it's way more money you can make. However, in both cases, you will be on the right side. You will not necessarily lose money if you know how to deal this. So the very, very important thing is this one, I call it an eye catcher. This one. If you see this one, I will show you in a few seconds some in the real chart, for example with the German DAX currently. Maybe we will find others too. However, if you see something like this, you're normally awake and say, I missed this good opportunity. In the future you will say, hey, that's cool, I saw it, now I'm awake. Now I know there's something coming. Okay, this is the eye catcher, this first part. The second part is the sales offer. In this case, they give me a good price. I want to see the market is coming down. So in this case, I say, hey, I want to buy it, but hey, give me a good price. So I wait for the setback. And the setback should be like good negotiation. It should not fall down in a really steep way. It should be in a corrective pattern, in the ABC one, taking a longer time, whatever it is. But it should be coming down and not too strongly. I sometimes use the picture about switching between the bulls and the bears. I want to see who's the strong guy and who's the weak guy. And if I know who's the weak guy, then I go to the strong guy and say, hey, I'm with you. Sounds a little bit unfair, but that's trading. You always check who's the strong part in the stronger party in the market. And you're going there and saying, hey, I'm with you. You don't need to trade against the big boys or big girls in the market. That's not necessarily the important thing. You can stay, even if you have a small account, a private account, whatever it is, which is typically not comparable to a fund, a big fund manager account or whatever. Even in this case, you can stay on the winner side because you don't fight against the big players. You're fighting with them. So the only thing you need to know is which is a strong guy. So and if I have the eye catcher situation on the left-hand side, I know, hey, these are strong. And if you see a weak correction on the lower side here, on the right-hand side, the second wave, then you know, okay, this part is really weak, so I can stick with the bulls and just need to enter a typical entry points. We will talk about entry points in a later webinar, I'm quite sure, but one easy entry point is the last intermediate level here. Others are maybe the trend channel. There are many others. I also use something I call the green line entry, which is giving me an improved, a more aggressive entry at a lower point. However, in this situation, we will just stick with this one. So you have a good idea. At that point, we have a good chance that the corrective part is over and we are continuing to the upper side. So that's it so far. I just don't need to show you this one. This is not so much important. You can, of course, combine this with Fibonacci. We will have a Fibonacci webinar. I don't know the exact date, but this will come soon. Talking about Fibonacci. Elliott Waves and Fibonacci is fitting very perfect together. And I think we will do some practical webinars on this one too, so that you can easily apply this and know where and at what time and what time frame and how to draw this. we will do this in the near future. However, you can stick with all your other things you're already using, maybe be indicators for, let's say, divergences, or you can use candlestick or candle formations, whatever you use already, and you can apply it to this one. So the simple setup in this case, and after this we are switching to the chart, the simple setup is that after the first start, the market is going up, and the second one, the corrective pattern, we expect something that will continue to the upside. That's something I normally like to see, and if I see this, I say, hey, this is a perfect situation. Let's do it that way. So, okay, let's not do it that way. Let's just see how it applies with the real market situation. And here we have the Dow in this case, it's an index. We can switch to the future, of course. However, this is the trading platform of AgenaTrader. I like it really, really much because it is giving me, it's taking away a lot of workload. So it is easy to apply, it's easy to work with it, and it helps me a lot while trading, keeps my head clear and focused for the real important thing. So maybe you have this software already, or just try it, because you can have a free test run on this whatsoever. So I'm using this one, and normally for a longer time frame, if I'm trading longer time frames, I have, for example, a weekly chart, a daily chart, an hourly chart, and a 15-minute chart. This is my setup, for example, when trading stocks. I like trading stocks. The stock market is really, really good, suitable for trading. However, I also have a shorter time frame for, let's say, a future. So we can have, let's say, the S&P future, in this case, the mini S&P. So on this machine currently where I'm doing the webinar, I have a delayed information here, but nevertheless, the futures are also working really, really good, and you can, of course, apply this in this, or even on lower time frames, down to 1 minute if you like to. Okay, so let's have some examples where we can see what the market is doing currently, or will do in the near future, and where we can apply these ideas with the Elliott waves. So at the first glance, it is to see where are the eye catchers. If you can see them, then you have done the hardest job maybe. No, it's not the hardest job, but it's because it's really easy to understand this. If you have an eye catcher, then just wait until the market came down and give you a good opportunity to enter the market at on a lower price level. So currently we have a good situation, as I see with the DAX, for example. So I just want to show it because this is giving a good opportunity. Maybe you're trading internationally, then it's not a problem anyway. If you're sticking with, for example, US markets or other markets, then of course you have to check this on other markets too. We will switch to the US market, stock market, for example, very soon. However, what we see here in the last, it's an hourly chart, it is a really good situation. The market was shooting up really strong. This is the eye catcher situation. If you have something like this, this is a perfect situation to wait for a good trading situation. However, what we need now in this case is something like a corrective pattern coming down. It could be something like this. It's a little bit more complex one. It could be something like just an A, B, C situation. You can, of course, combine this with Fibonacci. I will talk about this later, I've told you already. But you can easily see, okay, if the market is coming down into the typical areas, maybe reaching some cluster, Fibonacci cluster, then you have a good chance that the market will turn at that point. However, that's a little bit too early. We don't know this so far. But if you see something like this, just wait for a corrective pattern to the downside. If you don't get anything in a corrective manner. If you see a strong move, then you would not trade it. So, for example, if you see something like this is a strong move to the downside, and you have a strong move to the upside, you know you will never go short on this one because it's not corrective to the upside. So you cannot mistake it. That's a really good one. If you have a really strong move to the downside and a comparatively weak or three-wave pattern to the upside, then of course you can think about trading the market short, for example, if the market is falling through this level. And you should expect something that is going nearly same distance, at least 80%. I have some kind of a special tool here. I have a Born package here on this one. We've made this for most of us is used for us traders in the asset management. However, sometimes our clients using by themselves if they like to. However, if you want to measure how far the market will go, the typical thing is something minimum between 18 and 100. Typically it's 100% of the first move, but it should be at least into this area, 80 to 100%. This is a typical target for the continuation of this pattern. So this is a really, really easy way to see it. Even if you cannot count what the market is doing. But sometimes you can easily count what the market is doing. I just stick with the DAX this time, and then I'm switching to the Dow because you can see that there too, but I want to give you a chance to see it by yourself, so just starting here with the foreign market. The German DAX, in this case, has a good situation which we can count in a really good Elliott Wave manner. So we developed here some kind of an Elliott Wave pad for the AgenaTrader, and this is not counting automatically. Many people are asking us, why can you do it, or can't you do it, that it is counted automatically? Yes, it is possible. There are some software on the market can do it automatically, but to be honest, I was learning a long time ago, and my first contact with the Elliott Wave was with automated software, and still these automatic softwares on the market. However, it is not giving the real impression of the market. Don't believe the counting which is made by an automatic program. The problem is that it always suggests one counting. And obviously it is the most probable counting. You can of course measure this, and you can think about the rules and the guidelines, and then you can rate this and can say, okay, this is the most probable one. That's a good one. However, the second probable one may be only a little bit lower rated, but you will never see it, and maybe you will have a completely different conclusion on this one. You will never see it because you only see the most probable counting. This is a big problem with most of the automatic Elliott Wave programs. I learned with the program where you had to, unfortunately it's not possible to have it anymore. It was not really comfortable. You have to learn a lot about this. So maybe in the future we were thinking about to implement something here a little bit more automatic, let's say semi-automatic, I don't know. However, so far we just believe best or believe what we do is better than what any machine can do fully automatic. So however, this counting pad, this Elliott Wave pad we have here, allows us to give us different countings. You can choose, of course, different time frames. I don't want to dig too deep here because it's not important so far now. I just take this one, the counting for 1, 2, 3, 4, 5. And if I apply this one, you can easily understand this definitely is a 5-wave move. You can see it's definitely not overlapping because the second and the fourth wave are definitely not overlapping. So I think this counting is quite a good one. And after this fifth wave, we should expect something corrective. And if you have a first look at this one, between this parallels maybe it's not perfect for this market because it's now it's fitting perfect on the lower part. Now it's fitting, no, not perfect, but it's fitting a little bit on the upper part. So whatever you're doing, it's not perfect. However, the move between these lines, roughly like this, is definitely not impulsive. You can easily understand this is a corrective pattern. We have so much overlapping. It's so much more flat. You can see if you compare the move to the upside, and you can see this is the same angle here to the downside. You can see this is completely slower. This is more going to the side, overlapping between parallel lines. This is definitely a corrective pattern. Even if you cannot count it at the first glance, you can see this is a corrective one. You're absolutely sure this could not be an impulsive move. However, even if you're not absolutely sure, and if you want to have more information, you can take a sub counting. So you can easily see even the internal one, for example, like could be like this, and you can even change a little bit here afterwards. You can say, okay, this is maybe some more complex. I don't want to tell you about this one now. However, you can understand, this is the fractal thing. We have a pattern inside a pattern. Yes, we can understand. It looks like this a little bit. So it should be perfect. You can also have this on a corrective one. I don't want to do it now because I'm not feeling well to apply some letters or numbers here. It should be letters because of the corrective part of it. It could be something like an to be honest, I'm not absolutely sure whether this is a really complex C wave here, which is coming to an end. However, I can understand that maybe the complete corrective pattern we had here so far is now ending because the end here is really a strong one. You can see this is a bull market, a really strong one, the eye catcher I mentioned before. And you can easily see, okay, this can start a next one to the upside. I'm not absolutely sure, but currently this is a very good eye catcher. And remember, if the market is shaking down, then I'm sure the bulls are back in town. They're really strong, and the bears, they are the cowards, not knowing what to do. They say, I'm afraid, taking profit. I should not go too much short. Okay, that's a good indication if the market is doing like this. I'm quite sure after leaving this trend channel, or better in this case, don't use the trend channel because it's not an exact one. So please don't use this for an entry signal. I like the idea of using setup and trigger, a really important thing for trading. However, in this situation, with this unclear situation of the trading channel, I would prefer to use something more stable, which is, let's say here, this last intermediate high, which gives me a good idea that the market is leaving whatever he did before. Not absolutely sure. Always use management, money management and risk management. Use stops, of course. However, you have a good chance that you are on the correct side here in this case. So maybe you have a first impression how markets are working. So now let's switch a little bit. Let's see how the markets are doing in other regions. For example, here, if you have a look at the Dow Jones, I can also apply the counting. Let me just do it here. This is let me do another counting here, one level higher, because we have here a weekly chart. So all of these bars are indicating a complete week. You can also have the candles, no matter what. I prefer, to be honest, I like the bars. However, it works nearly the same. So, however, we have the first wave up, the second down, not coming below this point, so this rule is okay. The next one is a third wave up, a fourth wave down. You can easily understand the fourth wave has an easy three-wave internal structure, nothing to misunderstood in this situation, and you have a last wave to the upside. And that's different from the German market. We so far did not come back really low. So just applying for these guys knowing about the Fibonacci's already, we can see that the market did not came back so far. It is not, it even did not reach the 23.6 Fibonacci level, which is really the first one. But normally the market likes to come back at least 38.2, or even better, the area between 50 and 61.8, or the level of the fourth wave, which is also nearly 70,000, 60 points, roughly spoken, here with the index. However, there we have some way to go. Nevertheless, so far what we see currently with this downside move, if you have in mind this portion of the market here, which is this one, you can also see that this one is not really impulsive. Not really impulsive does not necessarily mean that inside here or here or here or here could be strong moves. Absolutely possible. However, if you see the market started from that point and currently is at that point. So it is currently, it seems to be a down market, bear market. And you can easily see this part is not really impulsive. We have kind of overlapping. Remember, this is the lowest point of this wave, and the next one here is higher than this one. So no matter how you count it, I cannot count. I can count, yes, of course I can find something, and everybody will say afterwards, yes, okay, afterwards it works. However, I don't try to. Normally in my daily business, I don't try to use any countings for this. I'm absolutely sure this is currently not giving me an impulsive impression. It's not looking like a dynamic move, not like an impulse. It's not the same like we had here, or let's say here, this part. You can easily see that even if you have a deeper glance here on the fifth wave. Do you see the fifth wave? This one here, from June, end of June, up to mid of August. This is this part on a lower time frame. This is a weekly chart, this is a daily chart, and if you have this one, you can see that within this pattern we had I'm talking Japanese, that's not correct. No, I'm in Tokyo, so it's an early morning hour, so don't get the wrong impression if you think, hey, this guy needs to sleep. Yes, indeed, he needs. It's a little bit funny to work here from 5:30 to 6:30 in the morning. However, as I like trading and I sometimes work really late, even after the market in the US, it's not so seldom that I'm really sticking with the markets or with the webinars so long. So nevertheless, you can see that also in this situation we have it's wonderful, it's beautiful. It's again this 5-wave pattern. And you can see this one is part of the bigger one we had here so far. Please remember what we've drawn on the weekly chart. It's exactly the same. So the Roman letters here are the bigger picture, and the internal, or you can see the internal move here, which is giving us the impression for the lower time frame. And you can sometimes you can even do it really to low degrees. I just want to give you a little bit an impression about the market is going. This is maybe not the perfect counting. If you're an Elliott Wave expert already, you may think, but it should be like this. Yes, you may be right. I don't want to overestimate it now. It's just to give you an impression about the market. Is at the first glance is giving you a 5-wave pattern. So you can easily see, okay, here are corrective patterns. It was here and here, and maybe on the even lower time frame. Let's go one below. You can say you have 1, 2, 3, 4, 5. Maybe, I'm not absolutely sure. I should measure the third wave because the third wave is not allowed to be the shortest one. The fifth wave seems to be the longest, of course, but hopefully, or maybe I did not measure so far, but it looks a little bit that the first one is a little bit longer like the other one. I'm not absolutely sure, but just to give you an impression how the market could be unfolded in different levels. And I think this gives you a good chance to understand how deep the Elliott wave is implemented in all of the movements you can see in the market. So let's switch a little bit to other markets. What we can see, if you're wishing for something, you just can name it now. However, unfortunately, time-wise, we have to stop anyway because the recording should not be longer than roughly like 1 hour. So I suggest like this. If you think, hey, this is a cool idea talking about Elliott waves, maybe it was tough for some of you to understand everything because it's maybe the first contact with this wonderful technique. However, if you like what you've seen, it is easy for us to do something again like this. We can do it again and again, and so you can have a chance to stick with this one and step by step continue learning and continue to apply this. So maybe the next few webinars I will do a little bit more practical work on a live chart. We can do it in different time frames, different markets. Could be FX, of course, could be single stocks, it could be the futures of the indices, whatever it is. We can do it nearly in real time. Maybe I'm talking too much about trading in real time. However, we can just do it even on this lower time frame. So if you liked what you've seen so far, then I'm happy because I like to trade the Elliott wave, and I can really recommend thinking about this, learning all this stuff. I know it's a little bit tough at the beginning, but you will come and understand this. So that's so far from my side. I hope you could enjoy. Until the next webinar, I hope you will stay healthy, stay successful. I hope you are successful with the markets. My best wishes for this one. Have a good time, and we will soon on the same channel. If you like to see this one, you can go to the AgenaTrader website and see this recording of this webinar in the near future. I don't know exactly which day it will be online. However, you can repeat it and can work through it again and again. So it's way easier to understand how it works. So have a nice time. See you soon. Bye-bye.